Muchas gracias. Llegamos ya a la última ponencia del día de hoy. Sé que está siendo una mañana larga. Hemos dejado para el final algo bastante bueno que está muy relacionado con lo que nos contaba el Mago Moore. Está relacionado con la innovación, está relacionado con la tecnología, el cambio, Estados Unidos, elecciones. Paso a inglés. I have today with me Grant Bowers. He is Vice President and Portfolio Manager of Franklin Equity Group. In Franklin Templeton, we manage over 300 billion in equity funds, and he is Portfolio Manager of various growth U.S. funds. In particular, he is the Portfolio Manager of Franklin U.S. Opportunities Fund. The fund is first quartile, year to date, 1 year, 5 years, and 10 years. Thank you very much for the performance. For those of us that have been invested with Brand, he has been able to achieve a 14% return on the last 10 years annualized. So thank you very much for that. I met Grant about 10 years ago, and it's always very interesting when I catch up with him. I always ask him the same question, and it's what's going on in Silicon Valley. He lives in the center of innovation, the center of technology. So Grant, what's going on today in Silicon Valley? How is life there?
It's busy. You know, I think, well, first and foremost, the best gauge of Silicon Valley is traffic and whether or not, how long it takes you to get to the office. And I have to say, it's about as long as it's ever been for me to commute to work. But in general, you know, living in Silicon Valley and being sort of right in the center and heart of all the innovation that's going on. And I think, you know, our speaker beforehand really talked in depth about, as far as I could tell, my Spanish is pretty poor, just that the world is changing and it's changing rapidly. And the people that, and the companies that adapt and change and embrace what we are really looking at and calling sort of digital transformation, the digitization of almost every industry around the globe, are the ones that are going to survive. And not just survive, they're the ones that are going to succeed. They're going to take share. They're going to have lower cost. They're going to really be the long-term winners. And the businesses that don't are the ones that are going to be left behind. And so for our standpoint, and my actual personal standpoint, on the ground, living in Silicon Valley, technology and innovation permeates so much of our everyday life, almost to the point where sometimes we question whether it's a good place to live, raising kids. You know, my kids have not just phones and are connected electronically, and it's the way they socialize and interact, but it's the connected devices in our home. We actually are using Alexa in our home to, you know, listen to the news, control the music. We recently connected it to our lighting and set it up so it can run lighting. I'm trying to get it to work. It's taking me a little bit, but Alexa can start my car in the morning. So I don't have to worry about having all the ice and snow on my car. I can just say, Alexa, you know, start the Jeep, and it'll start. But you know, those are the kind of the ways we're seeing change sort of impact our daily lives. What I see around me is probably more exciting. It's the Waymo self-driving autonomous vehicles that I see on the road. I recently was able to use a demo of a Waymo self-driving autonomous Uber, and it was great. I mean, I called an Uber. This car pulled up. There was no one in the car. It had a big screen. It said confirming where I'm going. There was a way for me to push a button and actually speak to someone if I needed to speak to someone. And we drove across town. It dropped me off, and it was fine. And I think what you're going to see is these things like autonomous vehicles, connected homes, are going to just start permeating more and more of our everyday lives because they simplify things, they improve productivity, they lower costs, and as I said, the businesses that are part of that digital transformation are going to be the long-term winners. It's not a one-year trend. This is something that's going to continue for decades. It's an area we've been thinking about and investing in for a long time. I'm always amazed the way things have changed from just 10 years ago, right? You know, no longer do you carry a map in your car because you have a map on your phone. Increasingly, you use cash less because you can pay with digital payments. Increasingly, you know exactly where everybody is at all times, right? It's almost impossible to get lost or be separated from somebody. So, you know, it's a pretty interesting time. And being in Silicon Valley, the great part is pretty much all my neighbors and all of our friends and our kids' parents, are running and starting these companies, and I can't tell you how many times I'm starting this new, digital tech company, and we're utilizing AI to solve this algorithm, and can I give you this product to check it out and see what you think about it? And that happens literally probably once a month.
Right. So technology is part of your life.
It's very much part of our life.
Innovation is a constant conversation there. Change is also a constant. So it's great that you are there and you can see on a daily basis everyone and what's going on the ground. So let's turn into markets, and maybe one of the first questions is going to be around elections. We had that question from the audience now. So I want to see your views from a U.S. equity manager, how the outcome of the elections will impact U.S. markets and U.S. corporates.
So obviously we had the elections. The markets rallied very strongly yesterday. My take and my view of it is, going into October, the markets were pricing in three big risks: interest rates, trade risks, and uncertainty around the elections. The net result of the elections is a bit of, I would say, status quo from a business perspective. The Trump administration's pro-business, lower tax, lower regulatory environment is not going to change in any way. If anything, by creating a divided Congress and more sort of political gridlock, you've almost ensured more of the status quo. So the markets are very happy about that, because President Trump knows that if he wants to be reelected in 2020, the economy needs to be doing well. That is essentially his measuring stick, the economy and the stock market, and he's going to use those to get reelected. So he knows, he views that as how he is going to basically put himself in position for election in 2020. So the election essentially removed one risk, and I would argue that it actually softened or reduced trade risk, because I think you're going to see a more, so the Democrats will be a counterbalance within the political spectrum to sort of temper some of the trade rhetoric, some of the more sort of extreme Trump policies. And if it plays out, from what we saw this morning, Donald Trump looks like he may pivot and embrace working with the Democrats on infrastructure spending, some health care reform and drug pricing changes. And so everybody can kind of say they won and sort of keep it going. But I viewed it as very positive. I think we took, of the three big risks, probably 1.5 of them just got removed. And now we're going to spend the next year thinking about interest rates.
Right. So the markets have seen with positive eyes the outcome of the elections. And as you said, Trump is very keen to keep the U.S. economy growing. I moved from the U.S. to Europe. I could feel that. I mean, taxes were much more beneficial for me in the U.S. than here in Europe. But so I think the economy, or the economy can continue or can keep going. So there was another question regarding the different investment styles, and Brooks was saying in the alternatives presentation that there are some managers thinking that this is the time for value, and the growth is going to be a little bit limited during the coming years. What's your view there? It's a question of value versus growth, or it's something else?
So obviously, as a growth manager, I'm a bit biased. But I truly do believe that it's not about growth and it's not about value. It's about winners and losers. And I think growth companies are, in the US, positioned to embrace all of the change we've been talking about and take share, grow, evolve, and be part of sort of the next couple of decades of business evolution. And those businesses, and most of them are in growth sectors, technology, healthcare, and consumer, I believe will continue to take share. The opposite side of the spectrum are businesses in more materials, energy, staples, and some of those companies will embrace a lot of this transformation, and they will survive. But I think the risk of looking at value broadly is that a lot of these businesses either can't or won't transition to this new paradigm, and ultimately that's where you get into a value trap, right? You get into a business that cannot evolve or is unable to evolve, or their business doesn't lend itself to evolving, and they're increasingly disintermediated. So from a very big perspective, clearly I think that the growth sectors and the growth businesses have much better long-term strategic positioning. Can value outperform for periods of time? Absolutely. And will the markets, go from risk on to risk off? Yes. Do I believe that structurally growth equities will outperform value equities over the next decade? 100%. I think we've actually transitioned from a world where, all the academic studies tell you that value has outperformed growth. The mantra has been you own value and you rent growth. Right, in periods of outperformance. I think it's the opposite. I think you own growth and you rent value if you want to play both sides. And a big part of that is look at the constituents of the value indices. First and foremost, growth stocks are trading at a multiple or two premium to the overall market. Value stocks are trading a multiple or two discount to the overall market. We're not talking about like 7, 8, 9 times. Like value stocks are not really that cheap. They have underperformed growth stocks, but they're not trading at incredible discounts. You saw what Warren Buffett said just the other day. He said, we're buying back stock because there's not a lot of value in value, right? And value is not cheap by traditional valuation standards. It's cheap to growth, but that doesn't make it a value. Right. And then the other piece of it is, if you want value stocks to work, you need financials to work. And financials need to be a big part of the value indices. I see the banking industry as being healthy, not stressed, but I don't see it ever returning to levels of growth and profitability that we saw between 2001 and 2008. You don't have structured finance. You don't have hedge funds. You don't have prop trading. They're not doing a lot of the same businesses they were doing. So structurally, they're retaining more capital. Structurally, they're never going to reach the levels of profitability. Right. You want value stocks to work, you need banks to work. Right. And even now, and this is just to finish this, the big push on banks is interest rates. Well, rates are going up, banks should do well. We've actually seen net interest margins on banks compress last quarter because even though rates are rising, competition for deposits is increasing, and they're basically having that profit margin is just getting squeezed. So the consolidation in the U.S. banking industry that we saw in the financial crisis is not leading to a better competitive environment. It's leading to a more intense competitive environment. Right. So that's a headwind for banks.
Right. So it's not a question about growth or value. It's a question about winners and losers. Prices are where they are for good reasons. Growth companies are where they are for good reasons. Value companies are where they are, or those sectors, for other good reasons. And as you said, for the next decade, you think that growth companies will overperform value because their strategic initiatives are going to be, let's say, more profitable than the value side. So one of the main concerns is, and you touch base on that, is on valuations. And especially, and Brooks was showing us some data about the tech valuations and current valuations. So what are your thoughts when people say, are we living in a similar area of the tech bubble of the early 2000s?
I mean, so if you look at just the broader S&P is currently trading about 15.5 or 16 times next year's earnings. I've been sort of characterizing the U.S. market as fairly valued. I think it probably appropriately reflects the really good economic environment, the good sort of fiscal or pro-business environment combined with, we're 9 years into an economic cycle, right? We're not trading at extreme or historically outrageous valuations broadly. So I think the U.S. market is pretty attractive from a valuation standpoint. I think the U.S. trades at a premium to Europe because U.S. companies deliver 200 to 300 basis points of profit margin over European companies. Return on equities are 200 to 300 basis points higher than Europe and in emerging markets. So structurally, you should have a higher relative valuation. If you go into individual sectors, what you see is, technology trades at about a 1 multiple turn premium to the overall market. Nowhere near the sort of speculative bubbles we saw in the financial, or not the financial, in the dot-com bubble. But tech inherently has 2x the growth, about a couple hundred basis points of margin over the overall market. Free cash flow yields are some of the highest. Debt levels are some of the lowest. They're global businesses and legitimately are less economically sensitive when I talk about some of the companies in the FANG stocks and the Googles and these guys, because they're basically addressing, multi-hundred billion, trillion-dollar addressable markets, and the penetration rates are still incredibly low. So to use Google as a great example, Google almost for sure will grow their business 20+% for the next 3 years, and it trades at about 19 times earnings. So premium to the market, discount to its growth rate, it's not excessive, feels appropriate. They have huge market share, they have high potential growth. So we're not seeing speculative or excess valuations in the market. I'm kind of characterizing them as closer to fair, and I think you need to look at where you're going to see earnings and cash flow growth for where you're going to get alpha.
Right, so the situation is different than the one we lived during the tech bubble. And as you said, now the fundamentals of corporates, the earning growth, the cash flow is much different. So and valuations shouldn't be as an issue as they were in the tech bubble.
And these are much more mature companies. Now, you do see some spots of excess in valuations in some of the private market values, some of the pre-IPO companies. We see probably a couple of hundred private companies every year. And I'll tell you, 3/4 of the time they come in and they say, we think our business is worth $2 billion, and you're just like it doesn't make sense. Like, we can't get there, and so we're happy to see these companies and learn about their businesses, but I think sometimes the non-publicly traded valuations don't stand the same level of scrutiny. And often they get funding and sometimes they don't.
Right. So looking into 2019, do you still see the equity rally in the US for 2019? I think that's like the big question mark.
Absolutely.
Everyone has.
And I think when we look to 2019, the market is expecting an earnings growth rate of about 8 to 10%. So there is and it's very important, there is a deceleration in the growth rate, because we're coming off of 2018 growing 20+% to probably more like 8 to 10%. But we have not, so we've seen a peak in the growth rate, but we haven't seen a peak in earnings. So to us, the market is pretty attractive right now. I think we actually this correction we saw in October was is still a pretty good buying opportunity. You saw the market return to the consistent growers, the market return to the businesses that have large opportunities, and I think that's where 2019 is going to really start to play out. So we're still positive on the market. As much as we are what I would call sort of later cycle, our belief is that the economic cycle has been incredibly elongated. It's been much slower than people have hoped, but it's been much longer than people imagined. And I think that's going to continue. So my crystal ball from a macro standpoint and an overall market standpoint probably doesn't go much beyond sort of early 2020. I don't see anything on the horizon that changes the current sort of economic outlook and market outlook. Right. As we roll into 2020, you're going to have a presidential election. You're going to be, looking at some variables around interest rates, and we're going to have to reassess. But Yeah.
So 2019 and 2020 could be still good years for the U.S. economy, even though earning growths are going to be a little bit slower, but still be
still
on the positive
quite
side
healthy.
Or quite healthy. Yeah. Perfect. So let's move a little bit into your fund. So you are one of the portfolio managers with higher active share in the market. And I want to ask you, why do you believe that type of management is better, especially in the US, that many people have kind of gave up that market and are investing through ETFs into the market?
So as an investor, I've always believed that in equities there are winners and there are losers, and we are very comfortable not owning names in the index that we think are structurally going to be challenged. And we're very happy to own much bigger positions than the benchmark in companies that we think are going to grow faster, outperform, and deliver better returns. So, within the U.S. Opportunity Strategy, we have about 85 names in the portfolio. So we're not what I would call a concentrated fund. We're a diversified portfolio, but we have high conviction investments in our top holdings. So our top 20 names account for about 50% of the portfolio. And then we have what I like to think of as sort of a tail of smaller, more interesting companies that maybe are earlier in their growth phase, maybe earlier in their sort of evolution. We are able to invest in small, mid, and large cap companies, so across the cap spectrum. And often you'll see some of my small and mid cap names be some of the smaller positions. These inherently bring a little bit more risk, less seasoned management teams, big opportunities, but not as linear in their growth, right? You can get big variability. So we start small positions. I think as an equity manager, that's the right way to be positioned. I'm often asked, well, if you believe in your name so much, why aren't you more concentrated? Well, concentration brings incredible amount of risk and volatility, and you often end up being the number 1 fund or the number 100 fund. I would much rather be consistently top quartile and build on sort of consistent outperformance over time. And so, as an active manager, to me, that's the method that I think drives alpha. We have a research team of over 30 analysts based in California, covering the entire industries, all the industries of the S&P, plus all the market cap spectrum. And these analysts are great, and they're literally on the ground, meeting businesses, talking to competitors, talking to suppliers, understanding the whole mosaic around these businesses, and driving our recommendations, and ultimately driving the positions in the portfolio from the bottom up. So there's no big top-down, let's be overweight tech, let's be overweight industrials. It's purely a function of the businesses we like and where we see the best risk reward in our opportunity set.
Right, and maybe during the last decades where we've lived in a very low interest rate environments, differential weren't so wide. So maybe now it's the time where an active manager really can bring alpha to the table, right?
I think so.
Yeah. So going deeply into a little bit of into your fund. So maybe the month of October could be a good example, or how active you've been. So the markets have declined. What are the moves? How are you positioning your portfolio for the next year?
So if you look back over the last sort of within 2018, there's been a couple of, I would say, reasonably big trends within the portfolio. We have been consistently taking profits in some of the big FANG stocks. They are big positions in our portfolio. We've owned them for many, many years. We owned Amazon since 2005, Apple since 2003, and they are within our top 10 holdings. We still think the opportunity set is amazing and fantastic, but we recognize that these stocks aren't going to go up 50% a year every year. And so as a manager, to maintain the risk profile, we've taken profits in some of those big positions and looked to sort of plant some seeds in some smaller positions that we think are going to be sort of the next great companies, the businesses that we want to own in the future. So there's been some of that. The FANG stocks still make up a big portion of our top holdings, but we've managed the position size down modestly. The other side of that, when we got into some of the volatility in October, we were pretty cautious in the early part of the month, but as we kind of got close to that last week, we felt that there was a lot of indiscriminate selling. There was a lot of tax loss selling in the U.S. as funds have their end of their fiscal tax year. And what you saw was investors were basically getting rid of their losers and not buying anything, and just trying to represent themselves at the end of the period as being really smart by never owning some stock that was terrible. And so we were able to sort of take advantage of some of those in some of our names where we saw some indiscriminate selling, and build some positions. And then the other piece that I think is actually more interesting, there's been a number of IPOs in the last 6 months. We've seen some really good companies come public. We believe in their businesses. We think they're worth a lot more. They price the IPO, and we are very active in the IPO market. We get a position in the portfolio of maybe 10 basis points, 15 basis points, because there's a lot of demand. The stocks often open up 30 to 50%. And we usually will, if we want to own it, we're going to sit tight. Well, what we saw in October was, because these were new names, liquidity was changing, a lot of people were selling them, we were given opportunities to build some nice positions in some of these next great growth companies, and not have, to chase them up. Because typically we're not going to chase valuations. We recognize the market's going to be volatile and come to us. So it was an opportunity, and it was great because performance, we actually saw yesterday, a number of those names were up 10 to 12%. It was a nice contributing factor to performance.
That's great. So you took profits on the FANG stocks and you decided to invest in some of those companies that you like, but that you couldn't invest now with the new prices.
Yeah.
You thought those were good opportunities.
Yeah.
So maybe let's end with a question around the future technology. We have listened to Mago Moore saying that change is going to be there. So how do you see future? How do you see technology in our lives? How do you think that's going to impact?
My view, and I think as we've looked to position the portfolio, is it's going to stop being about tech, and it's going to start being about all the other industries underneath tech. And it's digital, it's technology, transforming everything else, and everybody else is starting to catch up. So I think the future for investing within these sectors, and also sort of the future transformation, is what this digital transformation, this digital environment, the levering of data science, data analytics, mobility, the connected devices, the Internet of Things, combined with AI and how that's going to change things, taking that sort of platform and going into healthcare, going into the industrials, going into transportation, metals, mining, energy. Every one of these sectors is going to go through tremendous amount of change and adoption. The tech companies are going to benefit because they're selling them all these tools. But all these other businesses, and as we're working to sort of identify the ones that are embracing change and the ones that aren't, they are the ones that are going to get more productivity, lower cost, better margins, better opportunities. They're going to take share. They're going to be more connected to their customers, because a lot of what's going on is businesses realizing that they don't need to go through the wholesale to the retail channel to their customer, that they can now go direct to their customer. And so they have a much better connection. They get better returns because they're selling retail as opposed to selling wholesale. They're able to market to that customer, understand that customer. So areas like consumer are going to change dramatically. Areas like healthcare are going to be vastly different. The way we think about healthcare today and the way healthcare is utilized, it actually structurally cannot service the growing aging population around the globe. This idea, if you think about it, I mean, you call the doctor, you make an appointment, you go sit in his office, you wait around for a while, you get to your 15 minutes, he sends you to another doctor, you visit him, you do this, you get some tests, and it's like the whole thing takes forever, and it's not efficient. I actually recently talked to my doctor, and I did a video call with him. And I didn't even really know he was embracing this. I had to get in and ask him a quick question, and they said, well, would you just do a quick video call with him? I said, yeah, sure. So I did a video call with him, 2 minutes. He answered my question. He said, this is that, this is fine. Talk to me when you get back from your trip. They're like, great, move on.
Right.
It's good for the doctor because he's still billing a visit. It's great for me because I was able to get access. So increasingly, like, healthcare is going to be transformed by those type of devices, more sort of connectivity, genomics, the DNA sequencing, personalized medicine, personalized cures, more targeted approach to medicine. So it kind of went on, but the reality is the best opportunities are going to come sort of outside of tech, where tech is enabling change.
Right, yeah, so technology will continue to disrupt different sectors and companies. The ones that embrace that change will be the winners. And
they'll be the guy running along picking up the animal.
Right. Okay, perfect. So I think, creo que tenemos tiempo para una pregunta, un par de preguntas. Si no, Grant estará por aquí. No sé si hay alguna pregunta. Vale, pues damos paso a Nicolás, que va a acabar cerrando el evento.
Bueno, gracias. Gracias por venir. Sabemos que no es un día fácil, que mañana es fiesta, que estamos empezando un puente. Y oye, ver tanta gente aquí hoy, pues para nosotros es un auténtico lujo. Han abierto la conferencia diciendo que llevamos 20 años. Yo llevo 20 años en Franklin Templeton. Y si llevamos 20 años, llevo 11, es en gran parte gracias a vosotros. Por eso os quiero dar las gracias. Yo soy Nicolás Peña, soy parte del equipo de Franklin Templeton, y antes de terminar, que pasaremos a una comida en el piso arriba, quería haceros un pequeño resumen de todo lo que habéis visto hoy, muy cortito, no os voy a aburrir, ha sido largo. Hemos tenido 5 de los gestores más importantes de Franklin Templeton a día de hoy y para nosotros pues es una gozada tenerles aquí. El mundo es muy grande, están todo el día viajando y conseguir que vengan a Madrid un día como hoy para nosotros es realmente un gran esfuerzo. De lo que habéis visto, ha abierto Javier con un panel con 3 gestores, donde estaba Sonal Desai, que es la cogestora o cojefa del Templeton Global Macro Team, y probablemente os suene más los fondos que gestiona. Ella es la cogestora del Templeton Global Bond y Templeton Global Total Return. Es un estilo de gestión flexible. A nivel global, lo que vemos es que la flexibilidad para moverte en todos los mercados, en países, en duraciones, es fundamental para conseguir retornos positivos, y eso lo estáis sufriendo vosotros. Veis el mercado cómo está y cómo está la renta fija. El Global Bond a día de hoy lleva en dólares un 3%. Entonces, lo que identificamos, y si miráis nuestras estrategias, Global Bond es nuestra apuesta en este área, es flexibilidad para evitar la duración, que es uno de los principales riesgos. Estamos en duraciones muy cortas, porque los tipos están bajos y acabarán subiendo. En renta fija global evitamos mercados desarrollados porque no hay rentabilidad y creemos que siendo selectivos podemos encontrar mejores rentabilidades en emergentes. En este panel estaba también David Zahn, el responsable de renta fija europea. Si le oís hablar, él no ha hecho presentación, pero su punto de vista para la renta fija en Europa es: no habrá subidas de tipos hasta 2020 o 2021, cuando el consenso habla de 2019. Bueno, esto es aceptar o entender que la renta fija en Europa o las rentabilidades de los bonos van a seguir siendo bajas durante bastante tiempo. Aquí apostamos también por ideas flexibles, tanto en duración como en países. Nuestra apuesta es un fondo, el European Total Return, totalmente flexible en duración y en países, y es un fondo que a día de hoy ha conseguido las 5 estrellas Morningstar. Todo esto os vamos a mandar un resumen, lunes o martes, de las estrategias y de lo que han dicho los gestores, pero bueno, esto es un pequeño cierre. También hemos tenido a Basel Khatum, que es el CEO del Grupo Global de Emergentes. Los emergentes probablemente os suene, o cuando oís hablar de Templeton, os suena emergentes. Hemos sido y somos un gran grupo emergente. Si miramos los mercados emergentes a día de hoy, los países emergentes son los que están aportando el crecimiento al mundo. Cuando vemos un dato de crecimiento global del 3 y pico % es porque hay unas regiones emergentes que crecen por encima del 5. Después de las recientes caídas, los emergentes en media están a PERs de 10 veces. Pensadlo, son niveles de principios de 2016. Es una apuesta estructural, apostamos por crecimiento y ahí nosotros apostamos por muchas ideas, pero entre ellas probablemente la más importante sea Franklin India. Quedaros con la idea. Apostamos por India a principio de año, después de las caídas que llevamos este año, si nos creemos la idea de crecimiento, en India hay mucho valor. Hemos tenido a Brooks Ritchie, el gestor jefe de Franklin K2. Ana en su presentación hablaba de que de los casi 800.000 millones que gestiona Franklin Templeton, 40.000 son en alternativos. Y esto que entendáis que es una gran apuesta de la casa. Alternativos y dentro de los alternativos K2. ¿Por qué alternativos? Venimos de una crisis 2008 que se ha luchado a base de medidas expansivas, liquidez, quantitative easing, que lo que ha hecho es que todos los activos subieran a la vez. Hemos visto un incremento brutal de las correlaciones. En ese entorno es el entorno en el que los ETFs parecían la gran solución, porque nadie era capaz de batirlos. Vamos a entrar en un ciclo distinto. Se acabaron las bajadas de tipos, en Estados Unidos estamos viendo subidas, vamos a ver más, en Europa, aunque sea 2020, 2021 acabarán llegando, y en ese entorno lo que vamos a ver es dispersión. La correlación se va a reducir, va a aumentar la dispersión. Y ese es el entorno donde los mercados alternativos o los gestores alternativos lo podrán hacer bien. Aquí tenemos 2 apuestas, una que probablemente conozcáis, que es el Franklin K2 Alternative Strategies, un fondo que invierte en todo el rango de estrategias alternativas con un objetivo de volatilidad de 3 y 5%. Y la segunda idea es una idea más conservadora, que para nosotros es una gran alternativa al cash. Franklin Long Short Credit. Una volatilidad, el fondo va a hacer 2 años por debajo del 1%, con rentabilidades positivas. que si miramos dónde está la renta fija, es mucho. Y el último gestor que habéis visto, bueno, lo acabáis de oír, no os voy a contar nada nuevo. Yo me quedo con dos ideas, llevamos un montón de días haciendo calls con él, es el gestor que más nos demandan los inversores por hablar de Estados Unidos, dónde va el mercado, dónde va el ciclo. El otro día hablaba con él y la pregunta es, ¿estamos en el late cycle, estamos al final del ciclo? Él decía sí. La inflación sube en Estados Unidos, los tipos suben, pero esto no significa que se vaya a acabar el ciclo. Venimos de un ciclo muy largo, soportado por un entorno de liquidez total, que lo que va a hacer es alargar el ciclo. Y nosotros apostamos por lo menos 1 o 2 años más de ciclo en Estados Unidos. Y todo de la mano de tecnología. Habla mucho de tecnología y Javier le ha hecho muy buenas preguntas. Un dato, una anécdota que el otro día hablábamos con él es cuando publica datos Amazon hay caídas y la lectura fue que Amazon venía de crecer dentro de su negocio de cloud computing de un 46% el año anterior a crecer un 44%. Y esto alguien pensó que era desaceleración. Son crecimientos brutales que no hay en ningún otro sector. La tecnología sigue siendo una parte muy importante y lo es cada vez más del mercado americano, donde estamos muy positivos. Y el fondo que gestiona Grant Bowers, el Franklin US Opportunities. Pues esto es el resumen. Os mandaremos un resumen más amplio, os mandaremos las fichas de los fondos. Recordaros, tenemos una comida arriba, los gestores van a estar aquí para que habléis con ellos. Si no os habéis apuntado, la conferencia certifica como 3 horas de EFPA o otra certificación que tenéis. Y oye, y repetiros que muchas gracias, que no es un día fácil y que estamos encantados, que estamos aquí todo el equipo, con Javier, con Ana, con Inés, con Bea, y lo que necesitéis, estamos aquí para ayudaros. Muchas gracias.